Hey there, I'm Dan Vredeveld here with Richmond Brothers. Let's talk about something that comes up a lot when we're working with families on their retirement plans, and that would be beneficiaries. More specifically, what happens when you want to name more than one? Whether it's your kids, grandkids, a sibling, or even a favorite charity, making sure your wishes are clear is one of the best ways to protect your legacy and the people you care most about. When you name multiple beneficiaries for something like an IRA, things can get a little complex, but they don't have to get messy. With just a little planning, you can keep things simple and make life a whole lot easier for the people you leave behind. And even if you've already named your beneficiaries, it's smart to review them regularly, especially after major life events like a marriage, divorce, birth, or loss. That small step can make a big difference later on. So, let's walk through 5 easy tips for planning with multiple beneficiaries. Number 1. Well, first of all, why name more than one? If you want your IRA to go to more than one person or organization, you can absolutely do that without the hassle of managing multiple accounts. Just be sure you've got the right names in the right spots. Number 2. There's a key deadline to remember, and that's September 30th of the year after you pass away, and that's when the IRS locks in who your designated beneficiaries are. So it's important everything is cleaned up and clearly listed by then. Number 3, not all beneficiaries can stretch their distributions. If you name a charity, an estate, or a non-qualifying trust, those are called non-designated beneficiaries. They don't have a life expectancy, so they can't take advantage of any sort of a stretch IRA rule. If they're not cashed out by that September 30th deadline, your other beneficiaries could lose their ability to stretch payments as well. Number 4, separate inherited IRAs matter. Each designated beneficiary should have their own inherited IRA by December 31st of the year after you pass. That gives them more control and often a better tax outcome. These accounts should still include your name, but will use the beneficiary's social security number for reporting. Number 5, timing really matters. If the account isn't split up properly and on time, your beneficiaries might have to withdraw everything within 10 years, which can lead to higher tax bills than necessary. Also, keep in mind, beneficiary forms actually override what's written on a will. So even if your will says one thing, your IRA will go to whoever is named on the form. That's why it's so important to make sure all parts of your plan are working together, not against each other. And here's another big one. If there are no beneficiaries listed at all, those assets could wind up going through probate. And that can mean delays, extra costs, and a lot of unnecessary stress for your loved ones. The good news is that you don't have to figure this out on your own. We help families every single day with these kinds of details, so your legacy ends up where you want it, with the people who matter most to you. To help you get started, we're sharing a great resource from our friends at Ed Slott and Company, a nationally recognized leader in retirement tax and IRA planning. It's called Planning for Multiple Beneficiaries in 5 Easy Steps. You can download it below, and if you ever want to talk through how this applies to your unique situation, we're just a phone call away. At Richmond Brothers, we're here to help you live fearlessly into and beyond retirement. Thanks for watching.